In this video, Bitcoin's drop of more than 15% in a week, why the $60,000 level is so important, and how to hedge if we break through it. Plus, our traditional review of an option strategy for the week. Hello friends, this is the Optionomics channel, and I'm your host, Roman Besedovsky. Today, as usual, we'll look at what opportunities there are to earn with Bitcoin options. Let's start, as always, with last week's trade. Let me remind you that I had been waiting for a Black Swan event in Bitcoin for quite some time, and for a week where it would move more than 10%. And that week has just happened. So I opened a position. It turns out that when I was recording the video, if you look at the 4-hour chart, I opened it almost right before the drop. It was a very successful entry. So I opened it somewhere around, if I'm not mistaken, either Saturday or Sunday, when Bitcoin was trading in that narrow range, if I recall correctly, on Saturday around 73,800. And so I established a specific trading corridor, which essentially indicated that the market would either experience a significant drop below the level of 69,000, or alternatively see a breakout rise above 78,000. As I mentioned before in my videos, I was expecting more of a drop because, as I said, when institutional investors exit, if you remember in the first quarter, Goldman Sachs and other institutional players released their reports, and it was clear from those reports that they were getting rid of crypto. And usually that's a bad sign because it's the institutional investors who typically support the market, because small players, even if there are a lot of them, usually can't support the market. And for me, that was a very bad signal. So I understood that if accordingly, during this whole period, from about the beginning of March to the middle of May, Bitcoin wasn't able to grow, even though the American S&P index was rising sharply, which most likely means that someone was selling at that time. That is, while the news was good, they could sell, institutions were exiting. And as soon as bad news arrived, it turned out that the institutions had already sold everything, and there was no one left to buy for the time being. And look how quickly Bitcoin dropped. So it turns out that from 74,000 in just 5 days, it plunged and at one point even broke through 60,000. And why does the drop happen? Many people think that the drop happens because players are selling. But in reality, a drop usually happens when there's no one left to buy. So it turns out that after that rally, the institutions exited, and now when the market started getting bad news, there was simply no one left to buy at that moment. And if there's no one to buy, the market easily cuts downward like a knife through butter because it doesn't encounter any demand, and as a result slips right through even very important levels. And right now we've just reached the important level of 60,000. And here's what happened with that trade of mine. When the market in the first couple of days dropped below 69, I started to carefully lock in my position. So I had a position and I split it up. So what I had was I had 10 and 3 options on Bitcoin, and I ended up exiting this trade in 8 parts. That is, I closed the very first part of the trade simply because it had been a long time since I'd had any profitable trades, and I decided to at least lock in something at $1,000. So this happened probably when, let me check right now. On Tuesday around 8 p.m., my time, the market dropped below the 69 level, and that's when my first sell order at 1,000 was triggered. I sold a very small portion because I was expecting a much bigger move. The next portion, also small, I sold at 1,500, meaning I placed my orders in a ladder one after another. So I sold 0.51 at 1,000, 0.51 at 1,500, I think. On the same day, I also sold at 2,000 and a bit more at 2,500. And I had a large order set to sell at 3,000. Why at 3,000? Because I was expecting a movement of about 10%, maybe a bit more, maybe 11. So when I opened the position, the market was around 74. So 10% was 7,700. 74 minus 7,700 comes out to 67, and then another 766,300. Since I expected that there would still be some intrinsic value in the options, I was counting on being able to get about $3,000 with the options. And so the main part, which was already quite large, in other words, out of 10 3 options, I fixed 2 using a stepwise approach, 1,100, 2,100, 2,500. And I ended up locking in 4, so I had already locked in more than half of the entire position at $3,000. After that, I left the rest because I know that if black swans do appear, they can hit pretty hard. Then I locked in another 0.51 at $3,500 when the market suddenly dropped to $64,500. This was already Thursday. Yes, it was Thursday, the beginning of Thursday, maybe a bit earlier, and I decided to close out half of the remaining position at $4,500. So At that point, I had 1.77 options left, meaning I had closed 8.5 out of 10.3 at $4,500, and I left the rest until expiration because the market was dropping quite actively, and I thought that, in principle, the 60s could get hit before Friday's expiration, but in reality they didn't. So Friday's expiration happened. Let me check. Here's Friday at 4 o'clock. It closed at $63,113, but at one point there was a very interesting moment. Right before expiration, the market was pulled down, and then half an hour before expiration, when the price is calculated a bit differently, the market bounced back, and I got a pretty good close. So it turns out I closed my last trade at $6,200. Of course, if I hadn't locked in any profits and just held until the end, overall, it would have been much cooler. But since, in principle, no trader actually knows where the market will go, and very often during a falling market there are strong rebounds, I decided to lock in profits gradually like this so that I would feel comfortable psychologically. And look at what happened. My last maximum was actually during the previous Black Swan event when it dropped to 60. That was the week starting January 30th up until around February 6th. And at the peak, I had about plus 14% on my deposit. And look how much I had to endure. So it turns out I had to endure for 4 months, February, March, April, and May. And if you remember, in all those videos I recorded, I kept saying, guys, we just need to hang in there a bit longer, and so on. And then one trade comes along. And accordingly, pay attention to how much this trade shoots up compared to the previous small losses. And this is exactly the reason why 95% of traders lose. So 95% of traders are usually making small profits right here, where I was losing. They play the sideways market while it's ranging, and something like this happens. And most often, all those traders get wiped out. My strategy is much more psychologically challenging, meaning here I have to endure, 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 and endure. And you see this depressing decline in the account. Just imagine taking a loss every week. And then comes a single trade, and in reality, there isn't even much psychological satisfaction from it, because it happens very quickly, and as a result, you realize you have to keep sitting, trading, doing something. That's why, psychologically, this is much harder than if I were just collecting profits here, and then one day something unexpected happened. I'd just say, well, it happens, and lose, I don't know, half my deposit. Here, the situation is the opposite. So that was the trade, and I'm really glad I waited for it. Well, I would have waited for it sooner or later anyway. I'm just glad it happened now, and I didn't have to record another 10 to 15 videos about waiting for a move. Now, the most interesting part, what should I do next? So next, we need to understand that volatility is no longer as cheap as it was. And let's move on to our traditional plan. That means the forecast, then choosing the instruments, and finally, what risk we're willing to take on the trade. So let's start with the forecast. So regarding the forecast, let me remind you that the 60,000 level is very important. Why is it so important? First of all, a bit later, using open interest, I'll show that there are a lot of options concentrated there, and I think that a lot of players really hedged with options, so that if the market drops below 60, they could somehow hedge themselves against that loss. And now we are right at 60. Options. You see, after we last hit 60, volatility had been falling all this time, and then literally in 5 days it spiked again. But for now, it's still not as high as it was in the period from mid-February to the end of March. So, in principle, I think you can still buy something. Let's refresh the chart just in case. I think it's gone up now, and now Bitcoin will start to fluctuate again. Yes, you can see it growing on the hourly chart, but on the daily chart, honestly, it still feels pretty normal overall. But buying aggressively, like I did when the volatility was here, in my opinion, is no longer very reasonable. So now I'll have to come up with a slightly more complex strategy. So regarding the forecast, despite the fact that many people now think you should buy at 60, maybe expecting a rebound and all that, I believe that if the market breaks through 60, it could really take off strongly and quickly. Let's estimate how far it could go if it does break through this level. That is, on the weekly chart, our last low, which was in August 2024, was around 49,000. And I think that if panic starts now, we could very well drop down to that level. But buying weeklies now is already expensive, so we'll consider maybe some other options, like monthlies and so on. The second scenario is if the market still doesn't break through 60,000, I don't think there will be a strong rebound. I think there might be a bounce somewhere into the area of the previous consolidation, which, by the way, was quite high, but I don't think it'll reach 73. Most likely, it could grow somewhere into the 65 to 67 range. So there are two possible scenarios, either a small rebound or a sharp drop. And based on this forecast, I will build my position. Now let's take a look at what we have with options and open interest. As for Vela, I've already shown you, my friends, that volatility has increased, and now they're not as cheap as before. You can also see from Delta SQ that at the moment, on June 5th, just a couple of days ago when everything was flying, the volatility, or rather not the volatility itself, but the price of puts relative to the price of calls increased significantly. Now it has dropped a bit, but as you can see, it's still quite high. That is, we were almost at the point where calls were costing almost as much as puts in terms of volatility. You can see it here, not even over 2 weeks, but if you set it to a month, you can see that at one point, Delta SQ dropped by 10%, and now it's already at 20. So you can tell that there's fear in the market. Pay attention to the positions. Someone is buying 52 puts for June 12th. So just imagine we have until June 12th. Just about 5 days left, so that's exactly 1 week. And just imagine how much the market would have to drop for it to reach 52. That is, from the current Bitcoin price of 62, that's a 20% drop. Let's think about how much that is in terms of money. So that's 500 contracts with Bitcoin at 60, so that's roughly 60 times 600, about 6 million. That's about $30 million. Well, basically, that's a decent size order, but not very large for the Bitcoin market. So overall, someone could have just bought these options out of fear. So that's clear from the Vela website. Now let's move on to open interest. What do we have in terms of open interest? As of now, the largest open interest is for June 2026. You can see that the notional value is 9 billion, and the market value, if you take both calls and puts, is a little over $600 million. So if there's almost $1 billion in actual money in options for expiration, that's actually a lot. And you can see that fairly significant positions have already opened for September, and it turns out for December as well. And look, let's take a closer look at these major expirations. So our quarterly and semi-annual expiration will be at the end of this month on June 26th. And here we have quite a lot of options at 80. So overall, if someone is counting on a rebound, then 80,000 could act as a level above which it's unlikely to go. But I think that this green stick, which is the second highest, if you go from 80 down to 70, it will hold the market. That is, I don't expect that before the end, before June 26th, the market will be able to open above 70. That is after such a fall. And here is this big stick at 60. That is on notional value of $337 million. And if we look at the September expiration, where there's also a significant amount, pay attention to the fact that someone opened 75 puts, but they have already, well, basically, how should I put it? To put it simply, they are already in the money, and there are 60 puts. So here too is a big stick at 60. And for December as well, it turns out that the 60 level is the most important for puts. By the way, note that they will also hold 80,000 if it suddenly goes up. And if we decisively break below the $60 support level, I believe that the professional options market participants might start aggressively hedging their existing market positions, and could actively begin selling off futures contracts in the open market, so as not to lose too much capital on those specific put options they previously sold. And should that scenario actually unfold, I think the move down to 48 will be highly probable and entirely realistic, because an avalanche of sold futures could very easily and rapidly drive the market down. And since the situation in the Middle East is flaring up again, I think that if some more serious news comes out than what we have now, the movement there could accelerate. And let me remind you again about the S&P index. It hadn't really fallen much before this. And what I mentioned happened while the S&P index was rising, Bitcoin was barely holding on. As soon as the S&P index started to drop even a little bit, just look at how Bitcoin plummeted. If suddenly the S&P index accelerates now and drops somewhere around 7,000, considering what's happening right now, then I think we could easily see minus 20% on the cryptocurrency market. Those are my thoughts at the moment. And what else do we have left to forecast? Let's take a look. So we've already analyzed open interest. And by the way, what else did I want to say about open interest? Look, it turns out that I'm also watching the open interest on futures, and you can see that when Bitcoin dropped below 60,000, so what was that rebound? Earlier I told you about the drop, but what could be the reason for the rebound? Look, for Ethereum, the maximum open interest was when Ethereum was around 2,000, and here it clearly dropped. So those who were counting on a rebound from 2,000 got shaken out, meaning there were liquidations and so on, and that's why it decreased. And so in principle, if there's no more fuel left for further decline, no one else left to be shaken out, then maybe we'll see a rebound. By the way, the situation is similar with Bitcoin. That is, if we look at Bitcoin and the open interest in Bitcoin, we can see that here too. If we look specifically in Bitcoins, all right, let's do that. I can't tell if it switched or not. Let's check now. It seems like it's not switching. Here it is in dollars. And in Bitcoins. Yes, here in Bitcoins, you can also see that at a certain moment, someone was buying in the expectation that it wouldn't go below 70. You see, there was a peak in open interest here, and then it got wiped out. That is, the market dropped, and as a result, the positions were liquidated specifically in Bitcoins. Because in dollars, it's clear that open interest fell since the price of Bitcoin decreased. Therefore, in my opinion, there are still some small chances for a rebound right now. That's regarding the forecast. Next, let's take a look at the weekly charts. So here we have that very week with a 14% drop. At the lowest point, it dropped 17%. So at the moment, we still have a very long streak without any strong rebounds. So as you can see, there hasn't been a 12% rise in BT coin for 58 days, which is an absolute record. That is, if suddenly now they decide to squeeze out the short sellers, which in fact can happen at any moment, then on short squeeze fuel, there are often very strong rebounds. And that's why I think that at any moment, this 12% rebound could happen. Actually, that's not so much. I mean, from the current levels, that would be somewhere around 70. And regarding the series of declines, it turns out that the streak has reset, meaning there were 16 weeks without a drop, and now it has reset. That's why right now I don't feel like buying as aggressively as I did before. Let's add the data to the backtester. I've added a lot of it there. All right, let's copy it. And so what do we see? What do we see on Monday? It turns out that Bitcoin has just updated to 61,900. And what do we see? Yes, it's clear that buying options for a week right now is not profitable. That is, oh no, wait a second. We need to set the date correctly. June 12th. Yes. So it's clear that buying puts is not profitable. And if we look at the back tests, the most profitable put we have is the 64th one. You see how terribly it's performing. So since everyone got scared, puts are now very expensive, so you have to be very careful when choosing something to buy. And it turns out there's a slight advantage in calls. But also note that since volatility has jumped in both directions, you can see with the calls as well. This particular series you can see has been going on for about 50-something weeks. And you can see there's this rather dull declining trend here. Although, again, at any moment, if they start squeezing the short sellers, I think we could see growth here. And on Monday, I don't really feel like buying anything, so I'm going to take a look at... Alright, let's open Bybit now. Let's open Bybit. And let's open Position Builder. Let's see what we have with the monthlies. So we have the portal expiration on June 26th. And let's see how much the 54 points are going for. Yeah, they've definitely gone up already. Just a couple of hours ago, they were a bit cheaper. Now they've gone up. And you can see that they're selling for $650, buying for $655. In my opinion, that's a bit expensive. What about the 52 puts? Well, here they're more or less going for $460. Why don't I want to buy weeklies right now? To give you a specific example of how this works, if I take a look at the weeklies for June 12th, we can see that the 54 strike puts are currently priced at $240 each. That is to say, if I can buy the 52s for $400 for a total of 3 weeks, it clearly appears to be a much more advantageous strategy for us than taking the 54s for just a single week at $200 each. And as for the monthly options, I am strongly considering that I might want to go ahead and take those 54 puts. No, 54 is too expensive, 52. Right now it seems kind of unrealistic, but if we look at the chart, if we zoom out a bit, say to the monthly scale, you can see that so far, on the monthly chart, nothing drastic has happened yet. Yes, we've dropped by 16%. Well, it happens. So before this, in November, there was a drop of 17%. Nothing special about that either. Before that, there was also a drop on February 17th. And the last serious major drop in Bybit coin happened in November 2022. So how much did it fall then? By the way, you can see it was also a bit about 16%. So the worst drop happened in June 2022 when it fell by 37%. Now that number seems like something really unlikely. But I believe that, again, if things start to heat up and people begin selling off the S&P indices, then Bitcoin is far from being as reliable an asset as American stocks. That's why I think, since we haven't seen months like that in a very long time, a month like that, such an event could very well happen. So, for example, if such an event happens now, we could drop another 20% from current levels. That would be exactly the same bottom that was around 49,000. That's why I want to add this kind of position. And now the main question is, how much should I take? In other words, I don't really want to take full risks anymore since there was a good trade and now the prices aren't as attractive. So for example, I could potentially take about, let's say, 5 separate options at a price of $450 each. That total would come out to be about $2,250, plus the standard commission on top of that. The total amount comes out to roughly around $2,400. But since I am planning to hold on to this specific option for a period of 3 weeks, this total amount really isn't that large in the grand scheme of things. That is to say, if I was already willing to risk 2% of my capital for just a single week, then risking a little over 2.5% for an entire month seems like a perfectly reasonable risk to take. And however, since I don't want to just sit around in these calls waiting, I'm currently thinking about whether I can sell something else as well to optimize the position. So, for example, if we see the market suddenly take a sharp drop right now, those specific weekly options, which in my personal opinion look quite expensive given the current level of fear in the atmosphere, could potentially be sold for a premium. To give you a more concrete instance of how this works, I could look at selling some of the 60 or perhaps the 61 strike options to take advantage of that high implied volatility we are seeing across the board today. So, for a specific example, if the 50 to 52 strike options require an initial investment of $450, then for each of the weekly options with a 61 strike price that we sell, we are then able to purchase 3 of the 52 strike put options in this scenario. So what is the point of the position I'm explaining right now? If the market suddenly drops sharply now, I will have a rather large position in the 52 monthly puts, which will cover any losses that might arise, for example, from the currently sold weekly puts. If the market bounces back, then these weekly options will expire at 0, bringing me a profit and compensating for part of the losses from the 52s. So if I buy 5 of the 52 options, how many can I, for example, sell? That is, let's say I want to fully cover my losses, and for example, I can sell about 1.5 options. Unfortunately, Bybit has messed up the calculator, and now the calculator is covered by my face, so I can't say exactly, but I'll have to calculate it in my head. Then I'll just make my own calculator that's more convenient. So, for example, if I sell 61 at 1450, that's 1.5 options. For example, if the market shoots up to 52, what's the worst case scenario? That the market jumps to 52,000 in a week, and then with these options, if I sell them at 1,400, I'll lose about 8,000 on each one. So I could lose $12,000. Well, that's quite a lot. And that's almost 10%. And if it closes above 52 at the end of the month, then the monthly will give me another 2.5. So a risk of 14.5 is a bit too much. Let's consider another scenario. What if we decide not to sell 1.5, but instead, let's say we sell only a half? For example, if we sell exactly 0.5 of those 61 BUD options, they will provide us with enough coverage for a $700 loss. However, if the market suddenly shoots up to $52 again without any stopping, those same sold options could potentially bring about a much larger $4,000 loss for us. We need to be very careful with this specific strategy. However, if the market happens to shoot up rapidly within just a single week, then in actual fact, these specific sold options are effectively offset by the substantial gains realized on the 52 puts. So it's not that scary, and that's exactly why I think this kind of position is worth considering. By the way, the main reason I want to sell the 61 puts is because if we take a close look at the backtester, so if we check the backtester, so if we take a much closer and more detailed look at exactly what happens when we sell the 60-second puts and the 61st puts, you can really start to see what a remarkably clean, consistent, and beautiful chart it is for this particular trading strategy. That is, even if some kind of crash happens now, and here I have data from 2020, some kind of severe drop overall in principle with any normal growth, they managed to offset all of this quite well. That's why right now I don't want to just sit in a pure long position on monthly puts. Even though it's scary and so on, I still want to somehow offset the risk. So it turns out that, for example, if the market bounces back right now, I'll get $700 back from these options, which is actually quite good, considering the costs are around $2,000 in case a major crash does happen. And so probably that's the kind of position I'm planning to take into this week. Maybe, just maybe, it makes sense to take something in case of a sharp rebound, because put options are still cheap. Let's take a look at the backtester to see what we can take in case of a rebound. in case of a rebound. So we were looking at sold puts and sold calls because I don't want to be kicking myself if the market does end up going up. Let's see what we've got here. The 65s are priced at $500, the 66s at $355. Well, let's say there's some kind of super strong rebound, I don't know, let's say above 37. So, as I said, if they start aggressively squeezing the bears, I think a rebound of about 12% is quite possible, and that would probably be around 67. So 68 is already at 160, 67 at 240. How many can you buy? $245. So that means the increased risk for the position is about 0.2%. So let's think about how many more options we can add here. For a week for the 12th, call options. I don't want to add too many because I don't really believe there will be growth. That is, I think a small rebound is more likely. And for example, if the market bounces back to 69, I'll make about $2,000 from them, but that will just cover my expenses for the monthly ones. And so it turns out, by the way, your sold one will also expire at 0. Yes, that's probably the position I want to take for next week. Friends, I'll say right away that because volatility has increased, I now have to make some more complex decisions. I'm trying to explain things as simply as I can, but it is what it is. So if you have any questions, feel free to ask them in the comments. I'll be happy to answer. And let's see next week how this position plays out. So here, I actually have not 0 to 1, but 1 to 1. 167 call option bought. 0.5 of the 61 call options sold, and 552 put options for the month. My goal is to recoup their cost, unless it takes off. If that very Bitcoin crash does happen, which honestly I think is possible, though not a major crash, but maybe a drop to 30,000. Friends, thank you for watching my video to the end. I'd appreciate it if you give it a like or leave a comment. And as usual, let me remind you that this video is not an individual investment recommendation. You make all your decisions at your own risk. Be especially careful with sold options, because if they're not closed, the risks are much higher. And as always, I remind you that it's best not to risk more than 2 to 3% on a single trade. That's why I choose my positions with this in mind. Well, friends, this was Roman Besedowski with you. See you again on the Apstonomica channel next Sunday. Bye.